David Orguttery is the Chief Executive Officer of inSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm joined by Seth Edgil of inSOURCE Financial Advisors for a discussion about required minimum distributions, commonly known as RMDs. This is an issue that affects many retirees, but it is also an area that causes a lot of confusion. Seth, thanks so much for being with us today. Why is this such an important topic?
Thank you for having me. RMDs are one of those components of retirement that people often misunderstand. Knowing the rules can help people avoid unnecessary taxes, avoid penalties, and make sure their retirement income is managed efficiently. My goal today is to break this down in a way that is both practical and easy to understand. Now, I should mention that everyone's tax situation is different. What works for one person may not be the best move for another. These are general principles, not personal tax advice, and it's always smart to talk with a qualified tax professional before making year-end contribution decisions.
Well, let's start with the basics. What is an RMD, and when do people have to begin taking them?
A required minimum distribution is the minimum amount that the IRS requires you to withdraw each year from most tax-deferred retirement accounts. Under current law, which comes from Secure Act 2.0, RMDs can begin at age 73. That change took effect on January 1st of 2023. Anyone who has not yet reached age 73 follows this updated age requirement. According to IRS Publication 590-B 2024 edition, age 73 remains the current RMD starting age. Beginning in 2033, the starting age will increase to 75, but that future change does not impact today's retirees.
What accounts are subject to RMDs and which ones are not?
Most tax-deferred accounts are subject to RMDs. This includes traditional IRAs, SEP IRAs, simple IRAs, and pre-tax 401k and 403b plans. These are accounts where money went in on a tax-deferred basis, so the IRS eventually requires withdrawals. Roth IRAs, however, do not have RMDs during the owner's lifetime. That rule is stated directly in IRS Publication 590-B. Roth 401ks used to have RMDs, but Secure Act 2.0 eliminated those beginning in 2024. I still advise clients to verify this with their employer plan administrator because some systems have been slow to update.
So how are RMDs calculated?
RMDs are calculated using a formula based on two things: your account balance on December 31st of the previous year, and a life expectancy factor from the IRS Uniform Lifetime Table. That table was updated in 2022 and remains in effect today, according to IRS Publication 590-B. As an example, the life expectancy divisor for someone age 73 is 26.5. So if someone had a $500,000 IRA on December 31st, you divide that amount by 26.5. Their RMD for the year would be roughly $18,867. This calculation is repeated every year. If the market rises or falls, your RMD adjusts accordingly.
Well, penalties for missing an RMD used to be very steep. Has that changed?
Yes, historically, the penalty for failing to take an RMD was 50% of the amount you should have withdrawn. Secure Act 2.0 reduced that penalty to 25%, and it can drop to 10% if the mistake is corrected in a timely manner. That change is found in Section 302 of the Secure Act 2.0. It is still a significant penalty, and it is one reason why RMD planning should be taken seriously.
Once people know how much they need to take, how should they determine where the money comes from?
This is a key planning opportunity. The IRS only requires that the RMD be satisfied. It does not dictate which investments you sell or which account you draw from. Here are a few considerations. First, tax brackets matter. For some clients, taking the entire RMD from one account makes sense. For others, coordinating it with Social Security or pension income helps avoid unnecessary tax increases. Second, market performance matters. If one part of your portfolio is down, you may want to take the RMD from a segment that is performing better. Third, asset allocation matters. RMDs offer a natural opportunity to rebalance a portfolio. Fourth, the rules differ between IRAs and employer plans. Traditional IRAs can be aggregated. You can take the RMD from one IRA even if you have calculated the total across several IRAs. Employer plans like 401ks cannot be aggregated. The RMD must come from each plan separately unless the accounts are properly rolled over. These rules are found in IRS Publication 590-B and reinforced in IRS Notice 2024-02.
What about qualified charitable distributions? We hear those mentioned a lot in RMD discussions.
A qualified charitable distribution, or QCD, allows someone 73 and a half or older to transfer up to $100,000 per year directly from an IRA to a qualified charity. According to IRS Publication 590-B, a QCD counts towards your RMD, but is not included in your taxable income. For people who have already give charitably, this is one of the most tax-efficient ways to meet an RMD. The key rule is that the funds must go directly from the custodian to the charity.
What misconceptions do you see most often around RMDs?
There are several common misconceptions. Some believe that they do not have to take an RMD in a down market. Unfortunately, the IRS requires it every year, regardless of performance. Others think they can skip their first RMD. While you can delay the first RMD to April 1st of the following year, that often results in 2 RMDs in one tax year, which can push someone into a higher tax bracket. Another misconception is that Roth 401ks always have RMDs. As we discussed, that rule changed in 2024. And finally, many people think RMDs only matter later in life, when in reality, these decisions affect taxes, income planning, and Medicare premiums long before age 73.
Well, what advice would you give to someone approaching the RMD age?
I would encourage people to view RMDs as part of an overall income strategy rather than an annual task. Your RMD interacts with Social Security, pensions, taxable accounts, Roth accounts, and your long-term tax plan. Small adjustments made early can have a significant impact down the road. These rules continue to evolve, and staying current is important. Working with someone who understands both the regulations and your personal goals can help you avoid mistakes and create a more efficient withdrawal strategy.
Seth, any final thoughts for our viewers?
If you are approaching RMD age, or if you are already taking RMDs and want to be sure you're doing it efficiently, this is an excellent time to review your plan. Understanding the rules and coordinating your distributions can make a meaningful difference in both taxes and long-term outcomes. If you have questions, I would be happy to help you look at your situation and determine the best course of action.
Seth, thank you so much for the information and for additional information. Seth may be reached through the means listed on the following screen. For inSOURCE Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.